wants to know, where do we go from here? We've seen a lot of good news being priced into the market, but what's the next step? Are you wondering, should you be investing now? Have you missed the boat? We've got record levels of unemployment. We've got businesses shutting down. We've got hardly any travel, but we continue to see the stock market rising at a pace without any sign of slowing down. So if you're interested to know what my view is and what you should be doing, then stay tuned. Hi everybody, welcome to my YouTube channel. For those that don't know me, my name is Chi. As some of you may know, each month I like to do a recap of what happened in markets so that if you are an investor, if you're thinking of becoming an investor, you can watch a video like this and have an idea about what may have happened in your investments, what drove market action. Today's video is going to be slightly technical, so I'd say buckle up, settle back, and let's get into it. In case you weren't aware, May has been a terrific month for stocks. I'm going to focus on the S&P 500, which is a market-weighted index in the US, which tracks the top 500 companies. So by market-weighted, it just means the more valuable your company is, the higher the proportion it will represent in the index. If you're an investor in the UK, for example, and you want to invest in domestic equities, then you could look at the FTSE 100. In Germany, it could be the German DAX. But for the purposes of this video, I'm going to focus primarily on the S&P 500 because that's where a lot of the action is taking place. And a lot of stocks that we know about, like for example, Amazon, Facebook, Alphabet, Netflix, Microsoft, are represented in the S&P 500. So the S&P 500 rose over 4% in May. It's been up over 17% over the last 2 months. That's April and May 2020. And this is the best 2-month run in the index since April 2009. So let me just go back a step here in terms of what happened. In March, we had a lot of countries put their citizens into lockdown. So this meant that there was just no activity going on. And what this did is it made people think, well, there's no travel, people are losing their jobs. So it created a lot of fear and panic in the market. And then the market fell significantly in the month of March. Countries in Asia, some countries in Europe start to think about easing their lockdown measures and start to get control of the virus. And the reason why this is all really important is because we are very afraid of something called a bubble. So a stock market bubble is when the market is going higher and higher, but it's not supported by any real economic activity. And why is this important? Because at the end of the day, if you look at things right now, we've got record unemployment across the world in most countries. We've got hardly any travel taking place. We've got lots of businesses going bust, closing down, and being supported by their local governments. But we've got a stock market that is currently trading at levels that we saw 7 months ago, almost as if none of this matters. And that's really important because if we start to trade with such euphoria that the market just keeps going higher and higher, primarily because people don't want to miss out on a rally or the stock market going higher, but the economic activity which normally supports this isn't there, this is the definition of a stock market bubble. In March, when we had panic in financial markets, what we had across the world was central banks come in, slash interest rates, pump money back into the economy and pledge to do whatever it took to shore up their economies and to keep their economies going. This, without a shadow of a doubt, provided a boost of confidence to economies. The key reason why the stock market has done so well in May is because central banks have played their part by cutting rates and pumping money back into the economy. A handful of very large companies that are set up to actually do very well when people are asked to work from home or are staying at home, and they have primarily driven the price action that we've seen in May. The S&P 500 is market weighted. You've got companies like Facebook, Amazon, Alphabet, which we know as Google, we've got Microsoft, we've got Netflix, we've got Apple. All these companies are doing phenomenally well. Facebook is up over 15% this year. Amazon is up 32%. Alphabet is up over 5%. We've got Apple, which is up over 8%. Microsoft, which is up over 16%. Netflix, which is up over 32%. They don't require people to leave their houses. With growth of the internet, these companies have become invaluable to us at a time like this. And to be quite frank, this could be the new normal. What we could see is a handful of companies driving the behavior of indices going forward. Because a lot of the other companies in the S&P 500 haven't had a particularly terrific year, but it doesn't really matter because what's happened is that the larger companies have just become more valuable, they've become bigger, and they continue to drive the price action. It's not a broad-based market rally. The rise of the market is not being driven by all 500 companies. It literally is being driven by 5 or 6 stocks. So here's my view. a word of caution. I do think you should be involved in financial markets, because at the end of the day, it's not about timing the market. You're never going to get that timing perfectly right. But as I've mentioned in previous videos, investing a modest amount, or an amount that you can afford each month, in the stock market through a fund is a good idea. And I would definitely encourage you to keep on doing that, or to at least think about doing that. But volatility is probably going to go up. We've seen markets crash down in March. We've seen markets rise significantly in April and May. So what that means, a little bit more good news, the markets are going to go significantly higher. A bit of bad news, everyone is going to be rushing for the door. You're going to have panic. So what I would say to you is, do get involved, stay alert, but also be aware that volatility is bound to be on the increase over the next few months and years. I think investing in individual stocks might be a bit risky at this point, so I would definitely recommend going down the fund route. You can diversify some of your risk a bit more. When you invest in a fund, what you're investing in is the overall direction of the market, which I think provides a little bit more protection than going for an individual stock, which can do very well but can also blow up. Even if there's a drop in the market in the short term, I think over the next, let's say 5 to 10, 20 years, we should see the markets higher than where we are today. So therefore, I think getting involved is always a good idea. Nobody knows what's going to happen in the stock market. That is a fact. But we can all make educated guesses, and some of us follow financial markets a bit closer than others. So we make educated guesses based on information coming into us and probabilities. But the truth is, nobody knows. If anyone had said back in March that we'll be at these levels in May, we just didn't know. A lot of people were calling for a recession, for doom and gloom, and we are in a recession. But the point being that the market has been much more resilient than most market participants, if they were honest, would say that they thought it would. I'm not surprised that companies like Amazon, like Netflix, like Facebook are doing phenomenally well. Are you? It makes perfect sense. These are companies that when people are at home, who amongst us has not ordered something online through Amazon in the last 2 months? Amazon was designed and is designed to do perfectly well in these type of situations. But here's a question for you. We have seen governments around the world shore up wages for furloughed employees. In the US, they've been given stimulus checks, all that. Who's going to pay for it? That is something that a lot of people are not really discussing at the moment. That's going to be for another video, but I just want to highlight one thing. There is no such thing as a free lunch. All this money that's being pumped into economies, and rightly so, because we're in the middle of an unprecedented crisis, a pandemic. So it's right that central banks do their bit, but ultimately future generations, or maybe even us, are going to have to pay for it through higher taxes. Normally when we look at a recovery, it's what shape is it going to look like? So for example, is this a V, where we had a sharp deceleration in March and then we have a sharp acceleration in a very short space of time that we've seen in April and May? Or is it going to be a W? Sharply down, sharply up, sharply down, and then another sharply up? We just don't know. A lot of people are saying this is now a V-shaped recovery, but it could be a W. My personal view is that I can understand animal spirits. I've been watching the markets for years and years and years. The fear of missing out is very, very strong. People don't like the market to be going up and to be sitting on the sidelines. So it's very common when the market is going up, people just jump in, and that's absolutely fine. And also vice versa, like when the market is falling, people are literally rushing for the exit. My view is that it's come a long way in a short space of time. I'd like to see the economic data support that. At this point in time, it's not clear how many businesses are going to survive. When central banks around the world start to withdraw some of the stimulus that they've pumped into the economy, it'd be really interesting to see what it starts to look like. So I would feel a lot more comfortable if it was a bit slower and a bit steadier. What I sense now is some euphoria. And then there's also the question of, is there going to be a second wave? I have no idea. All I know is that I think investors should be alert, be cautious, and just to remember that markets can be irrational longer than you can be solvent. I think the market has gone a little bit too far too soon. That doesn't mean to say you shouldn't invest. I would definitely encourage investing, but I would say invest for the long term. Thank you very much for watching my video. I hope you found it useful. Do hit the like button because that helps support my channel and let me know that you want to keep on recording such content. Leave me a comment. Have you been following what's going on in financial markets? Are you surprised by how strong markets have come by? You know, hit the subscribe button and the notification bell so that you can get an alert each time I upload a new video. Thank you very much for watching. Take care and goodbye for now.